Thank you very much for taking time out and gracing this knowledge series. In fact, there was a break last month after almost more than 4.5 years, where we had a break in the knowledge series because we have changed the look and feel of the knowledge series. This month's topic is very interesting. We are going to talk about private credit space. There are a lot of nuances which the investor should know, and this is what we'll be talking. The first question which I have actually is, could you elaborate more about the private credit space investments?
Thank you for inviting me. It's great to sort of be here and share whatever little I can with the larger team as such. So fundamentally, debt as an instrument is always used for capital protection. It's the equity component that you take sort of your generate your alpha or take your risk with. So private credit is basically, I would say, a substitution from a return perspective of actually trying to generate equity like return, but having debt like sort of risk protection matrices. If you were to just analyze what are the various instruments available in the market from an investor standpoint where they can invest, it's either FDs or government bonds, RBI bonds, or debt mutual funds. And then the next space, sort of after the bond bucket, is your private credit. Now, private credit largely comprises, if I were to just tell you from a scale perspective, today that market is close to $20 billion and it's growing at a CAGR of close to 12% every year. In fact, even more. The three largest strategies within the private credit universe, one would be the performing credit bucket, which is largely in the 12 to 16% range. Then we have the special situation bucket, which is in the 16 to 20% broader range. And then we have a distressed stroke OTS space, which is largely into like the higher yield, the more risks that you take. As we speak, we are seeing a lot of transactions across this entire spectrum, not from just domestic players. You have a lot of AMCs that are coming up with their own private credit funds. You have a lot of foreign players also who are really targeting this market. So it's very, very heated up. If I were to just talk about broadly the strategies that are there within all these three buckets, the first bucket in the performing credit segment largely comprises of two strategies. One are strategies where you're financing corporate clients, where you're trying to find opportunities for companies, either from a capex perspective, bridging a working capital gap for acquisition financing at the company level. That is one sort of a product. The other is a strategy which is totally dedicated to financing financial services companies. So BFSI companies, like you put it. So you have a lot of players in that segment as well. Seeing equal interest. Again, from a number perspective, we have a dry powder close to 30 to 35,000 crores in this entire performing credit bucket itself today as we speak. On the special sit side, it's largely financing given to promoters. Loan against shares can be something, acquisition financing at the promoter level if they want to acquire something. Those mezzanine financing, those are sort of structures that one does in the special sit side. Again, a lot of dry powder there as well, a lot of big players who have been able to consistently generate return. And then we have the extra special situations wherein, if I were to just take a name of an example of Goswami Infratech, a transaction that's happening for the Shapoorji Pallonji Group, a transaction as big as $3 billion. That essentially falls in that category, which is extreme high risk. Again, the reason is, despite a group being of the pedigree of what Shapoorji is, the liquidity currently is not there. That is why it is priced at over 20%. So there are a lot of transactions happening in the entire performing credit space. If I were to just bucket it, anything between 12 to I would say a broader range, 30% is private credit. Within this, performing credit is 12 to 16, 16 to 20 is special sits, and 20 onwards is the distressed stroke.
Okay. What you talked about Shapoorji Pallonji is more of acquisition financing? Is it for financing the acquisition or
No, it's a refinancing transaction
refinancing? Okay.
where the promoters require some amount of capital to refinance their existing borrowings taken at the group company level. B, they want to infuse equity into the group companies.
Mhm.
So the repayment from a lender perspective, people who are investing in this instrument will largely come from either monetization of Tata Sons shares that have been pledged for this transaction, or maybe some liquidity event in case there is a listing of a group company called Shapurji Realty. So the group is very, very solvent from a liquidity perspective. It's not there today, which is why the transaction is priced at that range.
But tell me one thing: why will a good quality company, a rated company, go for a high credit, high interest loan? When he can go to a bank or he can go to an NBFC, okay, or he can go to some mutual fund also,
Correct.
and borrow at a cheaper rate. In
Absolutely.
fact, so what are the reasons why they approach or you invest in this space where that opportunity comes?
Absolutely. The first point is if it's a bankable transaction, honestly, transactions will not go to an AIF, like you rightly said.
Right.
If it's bankable or an NBFC transaction, it will largely not. When do AIFs largely get transactions? It's either because of scale. So sometimes there are a lot of transactions. If I were to just take another name of a company called Jaiswal Nico, I mean, the company had an OTS some time back. Asset was decent. It needed some bailout. Again, it approached one of my peers for a large financing. It's a non-bankable transaction. So, from an end-use perspective, whenever a transaction is non-bankable, that is where AIFs come into the picture. Secondly, wherever there is a flexibility of repayment required, that is where, from a bank's perspective or an NBFC's perspective, they are ALM to manage asset liability. That they have taken corresponding liabilities, so they require corresponding cash flows to come. AIFs don't have that challenge because investors who are investing in AIFs need to get the repayment at the end of the tenure. So from an ALM perspective, that is not a challenge which a lot of funds face. Thirdly, if I were to put it from a security standpoint also, there are a lot of flexibility which is offered from an AIF perspective vis-a-vis a bank perspective. Banks need to compulsorily get from a working capital side charge on current assets, from a term loan side charge on fixed assets, plant and machinery. AIFs, we are slightly flexible in that sense.
Okay.
So if I were to again get back to the same example, the Shapurji example, it's a non-bankable transaction. Banks can't fund it because the financing is required at the holding company level. And again, the end use itself is not permitted by RBI.
So this is basically the regulatory issues.
Exactly.
Because of which the banks cannot lend.
But apart from that, there are no
right.
cash flows also.
Right.
It is a promoter, it's an SPV.
Right.
So banks typically, how do you justify it? Banks can either give CC or term loans or GCP, which is general corporate purpose, which is technically not what they are supposed to do.
So this space actually got emerged because of certain restrictions. I can put it that way, from banks, NBFCs, and there is where this opportunity lies in the AI.
Absolutely. So there were two reasons because of which AIFs largely mushroomed. One would be from a debt mutual fund perspective, like the run which happened unfortunately with Franklin Templeton, and because of removal of the indexation benefits. These were the reasons because of which, from a return perspective, debt mutual funds typically did not become as attractive as maybe they were, I would say, back in the day where these things were not there. Secondly, from the standpoint of the broader market itself, RBI has this view from a scrutiny perspective. Way back, if I would say take you back, maybe say a decade and a half back, when NBFCs were mushrooming, at that point of time, there was a lot of regulatory arbitrage that NBFCs enjoyed compared to banks from an end-use perspective, from a structuring perspective. Somehow, a lot of NBFCs got adventurous, because of which the scrutiny of NBFCs increased tenfold. And RBI is also viewing NBFCs in the same lens as it's viewing banks. So whatever flexibility from a structuring and use perspective which NBFCs enjoyed back in the day,
right,
that unfortunately.
So I think that's where the opportunity lies. In fact, where NBFCs also now are restricted.
Correct.
And there's where the opportunity has come for AIFs.
Correct.
In fact, one more thing I wanted to ask you is that definitely, when you're getting a double-digit return, which is expected, a target return, which is a double-digit return, and it is basically, investments which you do where there is a gap, from where banks and NBFCs cannot, by regulation, they can't lend. I'm sure there will be a risk attached, in fact. There will be a risk attached. Now, coming back to the credit funds, the credit mutual funds, and I'm sure, a lot of our investors have invested, pre 2020 heavily in credit mutual funds. I'm sure, a lot of them invested because of high yields. And then we saw a lot of AIM mutual funds, they had delinquencies, the returns were negative. Now, I just put it into two parts actually, is that was a risk in credit funds. So how is it different from credit mutual funds? How is the AIF different from a credit mutual fund? Okay.
Right.
And second thing is that whether you have taken any steps that how can you actually curtail that risk? How does the risk get curtailed when you're investing in an AI?
Absolutely. So to answer your first question, how is it different from credit mutual funds? I'll not talk about the returns. Returns I've already spoken,
Absolutely.
but returns obviously are on the lower side for credit mutual funds vis-a-vis AIFs. If I just talk about the yield, 12% and above are sort of your AIFs. That's the broad range. Credit mutual funds are probably, I would say 10%, 8 to 10%, maybe 11, I would say. That would be the broad range from a return perspective. Largely from an underwriting perspective, your credit mutual funds can only invest, not only is the wrong word, but can largely invest in AA rated papers, A rated papers. They can't be offering bespoke solutions. The flexibility which AIFs have. Bonds per se don't have that flexibility because they're governed by a very different regulation. Our AIFs are governed by a SEBI regulation of 2012, where the flexibility. So, if I were to give an example, today, if there's a borrower, I'll give you a live example itself. The transaction that's happened with Hinduja, where it's acquiring the insurance wing of insurance business of Reliance, it's a zero coupon structure. That transaction per se, if a credit mutual fund were to underwrite it, it can't technically. Why? Because it's zero coupon. So, and plus the rating itself is BBB minus. But if you see from a participation from MNC banks, if you see participation from AIFs like mine, you'll see family offices, retail investors as well.
Right.
You'll see plenty of people participating in that very bond. That is the sort of structural flexibility is what I'm trying to say, which credit funds don't have. From a de-risking mechanism, the point is that no one really wants to get into IBC. So tomorrow, if there's a company that's not doing too well, if your call goes wrong, you want to be the first guy that gets out. So if I can talk about what we do at Sundaram per se, we have this idea of getting bespoke collateral, wherein we don't share pari passu charge with anyone, where the security is exclusively lien marked to us, which is what we can monetize at an appropriate point of time. And that is the same strategy, I would say, that goes with a lot of bespoke financiers also. So I would say, if you are there in a consortium, if you are there sharing pari passu charge, which is typically what happens in case of a credit mutual fund, that's where recovery mechanism becomes very, very long. Because once a company were to get into IBC, file a section 138, we are all seeing what's happened with Bhushan Steel as well, despite the order being passed way back in 2019, culminated in 2024 itself again. So the point being, if you are a sole charge lender, if you are a sole financier to a particular SPV, that's where it gives you an edge over being a part of a bigger portfolio and being a part of something where you can't monetize your asset.
Okay, what I can understand is there's one more difference, that AIFs invest in unlisted debt.
Absolutely.
Right? It's private credit. Actually.
Absolutely.
Okay, so basically they are unlisted. Okay. So, whereas a mutual fund cannot invest more than 10%, I guess, in the unlisted space.
Absolutely.
So is this one more difference which is there?
Yeah, listing is, I would say, it's a tedious process. If you were to ask me so I'll first give you the regulation. The regulation is not more than 51% of an AIF's investment, a Cat 2 AIF's investment can happen, not more than 49% of a Cat 2 AIF's investment can happen in listed paper. But then recently, 2 months back, SEBI came up with a carve out where papers which are rated A or below will also be termed as unlisted. So in the sense, it has given them flexibility to invest in a plethora of papers. Having unlisted papers, by the way, you can trade in unlisted. So it is a facet where it helps in ease of doing a transaction. listing per se increases your timeline from a compliance perspective also, because you need to have periodic disclosures. So it is much tedious for investing companies. But honestly, if you ask me from a risk standpoint, the risk doesn't change by
Okay.
making it listed or unlisted. Only the liquidity changes.
Okay. Okay. Now, I'll ask you about 3-4 bullet questions actually. So, one, who can invest? What category of investors should invest in a private credit AI?
See, anyone who's got a risk appetite,
Right.
who's looking, like I gave you the entire spectrum. You also have equity like returns generated in AIFs. See,
Right.
your Nifty has given you a CAGR of 15-16%
Mm.
annualized.
Hmm.
Here I'm talking about 20% consistent returns which some of the funds are giving. 1 crore is the minimum ticket size, which an external investor is sort of mandatorily has to put in the fund. So this product is good from, I mean, anyone who wants to, if I were to just talk about performing credit, anyone who's sort of looking at their allocation from an alpha over FD returns, an alpha over debt mutual fund returns, that is something that can be pursued from a performing credit strategy, where pre-tax returns can be between 12 to 13% largely. Someone who's probably looking for, I would say, some more adventure, some more asset diversification. And there are also funds that are generating 20 plus.
Okay. No, so we'll stick to the more conservative part of it actually. So what I can understand is that this is definitely for HNIs, because 1 crore is a minimum ticket size.
Correct.
Okay. And second thing is someone who wants to diversify from traditional asset classes. This is the second thing what I could understand.
Correct.
Is someone who has been there in equities, been there in mutual funds, debt, okay, fixed deposits, everything, and this is one asset, asset where he can invest as a diversification, and he can take that kind of a risk on
Correct.
an AI actually.
Correct.
My second question to you is: a lot of investors are used to putting in the total money upfront.
Right.
Okay, and this is something which even when we've been investing for our investors, we have realized is, that in an AI, okay, you cannot invest. You can commit. So you need to commit 1 crore,
Correct.
but then you need to invest whenever a drawdown is called for.
Correct.
Okay, why so? Actually,
now talking about the drawdown perspective, see, in this market itself, what happens is opportunities. It's very very opportunistic, because performing credit as a segment is giving money to good rated corporates as well as well performing corporates. So identification of those opportunities happens, I would say, periodically. It's not as if I have today also, as we speak, I would have a pipeline of transactions to invest in. But those analysis, the due diligence that happens, everything takes time. So it is not as if you commit and I draw down the money and I invest. It's all a sequential process.
Right.
And also every fund house has their own strategy. So whatever identification of opportunities within that strategy is also very, very, I would say, cumbersome. While opportunities are there, it's up to us to pick and choose which ones we want to sort of harp into based upon our strengths.
So my question actually was that why don't you take the 1 crore and look for opportunities? So in the sense that you put the money in, in overnight instruments, okay, and identify. Is it not allowed by regulation? Kind of a structure, you want to take it in form of drawdowns. So that's the question. Which
Great, great question. First, I talked about the nature. Regulatory, we are allowed to take the entire drawdown. The problem is if I don't have opportunities today, that money will be parked in liquids. So a liquid will probably give you, say, a 6% return. That is not something which the investor also wants. Why would he require a fund manager to manage his money and give him 6% returns? Which is why, in order to not, have stress on returns from an investor standpoint, honestly, this was the very feedback which we got from a lot of investors, where they had the entire corpus with them and they wanted us to manage. So Sundaram, as a business house, we have come up with a combo strategy where 75%, so hypothetically if you have 10 CR today, you can give me the entire 10 CR. 75% of that I will park in my debt PMS, which will again give you between 10 and 11% return. And my fund, 25% I will allocate for my fund, deploy it in my strategy, where we can probably get a 15-16. So that's how the blended returns of our investors increase. But regulatorily, there is no restriction.
There's no restriction.
There's no restriction.
That's wonderful. In fact, this is something which a lot of investors have been asking. And I think it's great, that we've got clarity that it's basically as a strategy of the fund house, whether they want to take it or not take it. They can take the complete amount upfront, okay, and then deploy it over a period of time. In fact, My third question is, something to do with, basically, I've heard that there is a skin in the game, that the fund manager also has to invest. He needs to be a co-investor. In fact, could you elaborate a little more on that?
It's basically sponsor. The regulation is
Mm.
it's either 2.5% of
Mm.
your corpus that you're raising or 5 crores, whichever
Mm.
is the lower of them,
Mm.
is the amount that the skin in the game of the sponsor needs to be there.
Okay.
That is the regulation.
Right.
Today, if in fact you also want to start a private Cat 2 private credit fund, all you require is a corpus of 20 crores.
Mm.
That's it.
Okay.
So
Okay.
today, as we speak, they're close to, they're over 300, by the way, Cat 2 AIF funds. In our case, specifically about Sundaram, sponsor commitment has been 15%. Sponsor and affiliates have come in more.
Mm.
But again, different funds have different strategies. There are
Mm.
some commitments which are in the lower single digits also.
Mm.
There are some fund houses where commitments are around 10% also.
My last question, and this I was talking about specific bullet questions, which I felt will be useful to the investors also, is basically one, can NRIs invest private credit AIFs? If so, are there any restrictions? Could you elaborate a little more on that?
There are no restrictions.
Mm.
NRIs can definitely invest
Mm.
as per the regulations. They just need to get their sort of tax orders in place from a taxation perspective, from which jurisdiction
Mm.
they are investing. I would say we ourselves have taken a lot of NRI investments in the past as well. It totally depends on which jurisdiction the
Mm.
NRI is investing from and whether we have a double taxation treaty with that particular jurisdiction or not.
Okay, wonderful. In fact, you have also come out with your private credit AI, and I think within that it's performing credit, which you corrected me. Could you elaborate more on that, actually, on the AI which you have launched,
Sure.
and the basic framework of the AI? Could you just elaborate a bit more?
Absolutely. So we've launched with Sundaram's first performing credit opportunities fund, which is a AA plus rated fund, by the way. So it's basically a part of Sundaram Finance itself, who's our sponsor, itself being a AAA rated NBFC. The idea is to be a sector agnostic fund out here, see opportunities from either a working capital gap, a capex, an acquisition finance at the company level, a refinancing. These are the sort of end use targets that we are doing. All transactions need to be secured by some amount of collateral. Major part of the financing that you'll see will be at the operating company level itself. From a sector perspective, the sectors that we are targeting would be auto ancillary, renewables, logistics, some commodities. Depending on what the opportunities are, what we'll shy away from would be non-ESG compliant companies and real estate companies. Because anyways, we have a dedicated strategy for that. From an exposure perspective, we'll take around like less than 10% exposure per investee company. So 12 to 15 transactions probably you can see in the life of our fund. We have done our first close last month, and we expect to do our final close by sort of 31st March 2026. Like I said, at the portfolio level, the returns can be around 15 to 16%. That's our target. Investors' pre-tax return can be between 12 and 13%. The regular quarterly coupon payouts to the tune of 2.5 to 3% is what investors who are investing in us can expect from us. And yeah, being sort of Sundaram franchisee, we would again first protect capital of our investors and then give risk-adjusted returns. So that is the sort of mindset and motto. Can't complain. Today, as we speak, running a good pipeline also of a lot of deals that should sort of collaborate in tandem with the drawdown that's happening. So there should be very limited negative carry, if at all there is, from an investor standpoint. People investing, like I said, the investment period can be until 31st March 26, maybe a quarter after that. We'll start returning principal by the mid of the fourth year itself, because we want to have a tail period of around 6 months, God forbid, from a resolution point of view. This is a 5-year closed-ended fund, and anyone who's sort of looking from an FD alpha and alpha over FD returns, or maybe some 30-40% premium over mutual fund returns, can invest with us and see what we are all about.
And I think, I was just going through your presentation. The first slide says that, credit in our DNA, actually. So I think, all the best to you for your performing credit AI, actually. And I'm sure it will be something to look out for. So it was a wonderful deep diving into this space of private credit, and definitely our investors have got to know a lot of nuances of investing in this space, and there were a lot of questions which are unanswered,
Hmm.
and I'm sure they have been enlightened with this talk today. A few points which I can understand and takeaways you can say for this knowledge series is one, definitely an investor who has appetite to invest a crore. I think that is the first thing.
Correct.
Okay, so this is not for a retail investor. It's for an investor, HNI investor who can invest about a crore, can invest in the AIF. Second thing is it can be used as a diversification. So who can invest? One is someone with a investable surplus of 1 crore. Two, basically you can use it as a diversification
Okay.
through your traditional fixed deposit, debt mutual fund instruments, where now debt mutual funds have lost their tax efficiency also,
Absolutely.
as well as someone who's looking at regular income. In fact, so you can get a regular income also. Most important thing is when you are getting this kind of return, what I could understand is that there is an element of risk, and that is something which you need to take into account whenever you invest. What portion you need to invest also becomes very important. That what is the allocation you need to give to this space, because with the high return will come an element of risk also. In fact, and I think the most important thing is that like what we just discussed, that it is a 5-year instrument, but there is a thing called cash in cash out, which means that the investment is going to be committed for the complete amount, but you will be investing over a period as and when the fund calls for the drawdown, and similarly you will get inflows in the same way, in fact. So I think it's a wonderful opportunity. Definitely, there are multiple products which will come from the funds, but you need to be careful as to which kind of fund you select. Like what we were just discussing, that it is in the private credit space, you have a huge gamut of where you can get between 12 to 16% return, which is also high.
Exactly.
As well as you can get a return of even 20%. So you need to understand that what kind of risk appetite you have, and then take a decision to invest. In fact, thank you very much for taking time out. Okay,
My
thank you.
pleasure. My pleasure.
Thank
Thank you, sir.
Yeah.
Cedrus Wealth Partners, orchestrating distinctive wealth management proficiency since 2007. We deliver transparent, unbiased, and comprehensive investment solutions. Today, we manage more than 3,000 crore rupees in assets, proudly serve over 1,000 families and 3,000 individual investors, and with a team of 26 experienced professionals, we help our clients achieve their financial goals. Our 360 degrees wealth management approach integrates investment planning, risk management, tax optimization, and legacy planning. We focus on the 4 essential pillars of financial planning to create a strong foundation for your financial future. Our advisory process is mutually exclusive and collectively exhaustive. We provide uncomplicated advice. No ULIPs, no NFOs, and no structured products. Our portfolio offerings include managed equity solutions for superior risk-adjusted returns, novel offerings including hidden gems that provide pre-IPO and niche investment opportunities, and alternate investment solutions like private equity, real estate, private capital, and multi-index investment strategy. From humble beginnings in 2007, Cedrus has grown with a commitment to innovation, excellence, and trust. With a global presence in key cities, Cedrus continues to redefine wealth management with innovation and trust. Discover the Cedrus difference. Your financial success is our mission. Contact us today to begin your journey.